6 years of university economics study failed to reveal how money actually works. Standard academic textbooks intentionally misrepresent the mechanics of our financial system, keeping the true nature of wealth hidden behind a screen of complex formulas. These enormous limestone discs on Yap Island redefine our understanding of value. Some weigh up to 4 tons, the weight of an elephant, making them impossible to carry or trade in any traditional sense. Because the stones cannot move, they remain outside the owner's house, while ownership transfers through simple village agreement. Even a stone lost at the bottom of the ocean during a storm continues to circulate as currency. As long as the community agrees the family holds the value, physical possession remains irrelevant. This realization exposes the flaw in the universally taught barter myth, the idea that humans first traded fish for bread before inventing money. Anthropologists have searched every continent and era for evidence of a pure barter economy, and they found nothing. Barter functions as an emergency backup system, appearing only when a primary money system has collapsed, such as in Russia during the 1990s. It is a symptom of economic failure, not the origin of civilization. The oldest writing on Earth consists of Mesopotamian clay records documenting promises. Long before the invention of coins, merchants used clay to record who borrowed tools and promised to pay them back after the harvest. The promise preceded the currency. Money was designed to be a stable measuring tool, functioning like a ruler. Just as an inch or a minute remains the same regardless of your location, money was intended to provide a reliable, fixed measure for human promises. The transition to paper currency began as a matter of convenience. Carrying heavy iron or gold was dangerous and exhausting, so merchants left their metal in secure vaults and traded the paper receipts instead. 17th century goldsmiths soon realized that while paper receipts were traded constantly, the physical gold stayed in the vault. At any given time, only a tiny fraction of depositors ever returned to claim their metal. This observation led to fractional reserve banking. Goldsmiths secretly began printing unbacked, fabricated receipts to collect interest. For every 100 bars of gold in the vault, they issued 150 receipts, banking on the fact depositors would never all arrive at once. This practice mirrors a parking garage owner who secretly rents out a customer's car to strangers for a daily profit. The owner carries the risk of their car being damaged or stolen, while the garage keeper collects all the reward. This systemic fraud was eventually institutionalized. King William needed money to fund his wars, granting wealthy merchants a royal license to issue paper money. They founded the Bank of England, a central institution that created currency based not on gold, but on the king's promise to repay a loan. The founding of the Bank of England moved the manufacture of money from private vaults into the center of state policy. This moment transferred the power to manipulate the economic ruler to the very institutions that profit from making it shorter. After World War II, the Bretton Woods Agreement attempted to enforce global honesty. Under this system, every global currency was tied directly to the US dollar, and the dollar was rigidly tied to physical gold at $35 per ounce. The system contained a fatal flaw. America printed excess paper dollars to fund foreign wars and domestic social programs, causing the global supply of paper to vastly outpace the static supply of physical gold. In 1971, as foreign nations began demanding their physical gold, President Richard Nixon unilaterally suspended the dollar's convertibility. This move prevented the total depletion of U.S. vaults, but severed the final link to a physical anchor. Overnight, the global economy transitioned into a fiat system. Every currency on the planet was now backed entirely by public trust, allowing the supply of money to expand without any physical limit. In this fiat landscape, the limit on money creation shifted from the physical weight of gold to the numbers on a digital ledger. This transition allowed private commercial banks to step into the role of primary money manufacturers. University textbooks describe banks as simple middlemen, lending out existing customer deposits, but this model fails to account for how modern credit is actually originated. When you sign a loan contract, the bank does not transfer funds from another person's savings. They type the amount into a computer and credit your account. Your signature on that contract is the precise moment new digital currency is manufactured out of thin air. This creates a mathematical impossibility. The bank manufactures the $10,000 principal, but never the $1,000 for interest. To clear that interest, someone else must take out a new loan. Society must continuously take on massive compounding debt just to avoid systemic collapse. This endless expansion of the digital money supply inevitably dilutes the purchasing power of the currency you hold. Every unit buys less today than yesterday, because the money supply grows at a pace that physical goods and services simply cannot match. This targeted inflation primarily benefits the world's largest debtor, sovereign governments. By keeping the inflation machine running, they quietly inflate away mathematically unpayable debt mountains over decades, repaying liabilities with diluted, weaker currency. The continuous erasure of middle-class wealth fulfills the intentional design of a matrix built to transfer power from the saver to the borrower. This is not a market failure. It is the system functioning exactly as it was intended.